Good day. My name is Letshego Rankin, and I'm the Executive Head of Institutional Distribution at Momentum Investments. We would like to welcome you once again to our session, Moments with Investment Gurus, where our investment professionals will share their views in terms of what to expect in 2021, what it means for our strategies we run on behalf of our clients. Now, before doing that, let me share a little bit about our business and its capabilities. Momentum Investments manages 608 billion of assets under management and administration with 47 investment professionals and 507 support staff. We are proud, responsible investors with a dedicated environmental, social, and governance team. We have a wide range of investment capabilities in fixed income, listed property, global, systematic strategies, which include smart beta and passive investments. Now, we also have an alternative strategy, which include hedge funds, private equity, high yield credit, and real assets such as student accommodation, renewable energy, and core infrastructure. As the world begins to emerge from the economic crisis created by COVID-19 pandemic, the big question in our mind is how does our country revive our economy to improve our gross domestic product and to strengthen policies that can assist in job creation. Now, in the past year, the world has been on lockdown and markets have experienced uncertainty and volatility. There have been many learnings on what we should be doing differently in the future, but also what remains the same. Now, with the first phase of the vaccines looming and South Africa having a decline in economic growth, we explore the effects of the new normal on the economy, on the investments, and different asset classes, giving a local and global perspective. Now, I hope you enjoy our session today. Feel free to post any question on our Q&A, and we will be able to respond to you after the event. Now, to set the scene, I would like to introduce Herman van Pappendorp, who is the Head of Investment Research and Asset Allocation at Momentum Investments. He will be giving us a taste of developments investors should watch out for in 2021.
Good morning, everyone. Thanks for tuning in. I'm Herman van Papenop, Head of Investment Research and Asset Allocation at Momentum Investments. Today, I would like to give you a glimpse into what we as investors should be looking out for as a guide to how the year 2021 might be playing out. Now, at the outset, we have to acknowledge that the South African economy and financial markets are inseparable from the global economy and financial markets. Why do I say that? Well, firstly, as a small open economy, South Africa's economic fortunes are heavily dependent on the trends in global growth, trade, and capital flows. And then secondly, the South African equity market, for instance, historically follows the directional lead of global equity markets, particularly that of the market leader, the United States. This is clear from this slide, which shows the similar directional trends in the South African and US equity markets in the last 10 years. In fact, we've done research showing that in recent decades, only 23% of the movements in the South African equity market can be explained by non-US equity market factors. This clearly illustrates that South African specific factors are only of secondary importance to determine the local equity market's direction. Should we be surprised by this? Not at all, given the current makeup of the South African equity market. This slide shows that less than 1/3 of the combined operating performances of the companies in the JSE Top 40 Index now originate from South Africa. This means that the bulk of the production, revenue, and profits of the South African equity market is linked to global driving forces rather than those specifically pertaining to the South African economy. Against that backdrop, we've identified three main themes that are likely to determine the outlook for the global and South African economies and financial markets in 2021. We call these the three Ps: the pandemic, policy, and politics. On the pandemic theme, the interaction during 2021 between the virus and vaccine developments will be crucial for economies and markets. The severity and longevity of consecutive virus waves and the evolution of virus mutations, together with the success or not of the vaccination process in terms of vaccine approval, mass production, distribution, and inoculation efficacy, will ultimately determine the opening and closure of economies around the world, and hence the economic growth impact, as well as the risk appetite in financial markets. Also central to the outlook for the global economy and asset markets this year will be monetary and fiscal policy developments. Remember that monetary policy loosening did the initial heavy stimulus lifting in the early stages of the COVID-19 crisis in the first half of 2020, with fiscal policy stimulus joining in later and fiscal currently maintaining the positive stimulus momentum for the global economy in the early part of 2021. On the political front, if we assume all else equal outside the US, a more predictable and less volatile global geopolitical environment is probable as the US moves from the Trump administration's unilateral and confrontational approach to international relations to Biden's more multilateral and cooperative approach. We think a better pandemic reality in 2021 than in 2020, the lagged impact of massive policy stimulus that should ensure an exaggerated cyclical global growth recovery in 2021, and less erratic US foreign policy should all combine to provide a conducive fundamental backdrop for risk assets. It is also important to remember that growth assets like equities typically perform best around growth and inflation troughs, while safe haven assets like bonds do best around growth and inflation peaks. So what can go wrong for such a risk-on strategy this year? The danger for risk assets is that a strong growth environment could induce the US Central Bank to start indicating later this year that it's likely to taper its asset buying in 2022. It is uncertain how markets will react to this threat to the liquidity driver that has been the dominant fuel for asset prices since the start of the COVID-19 crisis. Particularly as the momentum in excess liquidity is likely to decline this year, with the recovering economy needing an increasing amount of liquidity to sustain itself, leaving less of the liquidity pool available to support financial assets. This is in contrast to 2020, when a shrinking economy allowed more of the liquidity stimulus to flow into and underpin financial markets. Furthermore, any hiccups in containing the virus and with the vaccine implementation process could also cause periodic downside for risk assets in 2021. So while we want to be positioned in our portfolios for a general risk-on fundamental environment as we start 2021, we are cognizant of potential pandemic and policy risks that could require more defensiveness as the year progresses. What about asset class valuations, you may ask? Well, unfortunately, valuations look expensive in most global asset classes, with low yields implying lower than historic future returns across the board if there is some reversion towards longer-term valuation means. This means that the absolute return outlook across asset classes is not a very appealing one for investors. It then becomes a relative asset class choice story to defend overall portfolio returns for investors. Let's talk quickly about our views on the individual asset classes. At the outset, global cash exposure in a very low interest rate environment should be limited. Secondly, global bond exposure would be at risk if global growth and inflation drifts higher towards trend as expected in 2021. It thus makes sense to rather exploit the risk premium available in other, more risky asset classes to give some better absolute returns in a diversified, balanced portfolio. On top of this, global equities also look less expensive than both global cash and bonds. Within equities, the positive relative profit trends in favor of both growth stocks and the US over the past decade already seem to be fully discounted in their respective relative valuations. As such, value stocks and non-US equity markets now offer more compelling long-term risk-reward profiles than growth stocks or the US equity market. After years of poor absolute and relative performance, the South African equity market now has a more favorable valuation underpin that should also enhance potential return upside on top of an improving fundamental backdrop of positive earnings revisions. It is also interesting to note that based on the current level of the US equity market, the South African market seems around 10% undervalued. South African nominal bonds, as part of emerging market bonds, remain beneficiaries of the global carry trade due to the ongoing zero or negative funding rates in developed markets and the much higher nominal and real bond yields available in emerging markets than developed markets. And within emerging markets, South African real bond yields are among the highest, which compensate investors for South Africa's perceived fiscal risk. Indeed, South African real yields and yield spreads are multiple sigma events against historical averages. South African inflation-linked bonds are likely to receive fundamental support this year from a rising inflation trend, with strong positive monthly inflation accruals expected from the second quarter of 2021. From an asset allocation perspective, South African cash now looks unattractive, with a prospective real yield on South African cash close to 0%, which is more than 1 standard deviation below its historical average. This is due to the aggressive interest rate cuts from the South African Reserve Bank in 2020, as well as the rise in inflation expected during 2021. The South African commercial property sector experienced a further rapid weakening in its fundamentals in 2020 due to the destructive impact of COVID-19-induced lockdowns on the economy and its tenant base. This meant that rental holidays had to be instituted, negative rental reversions became the norm, and vacancies started to rise. While this trend is likely to continue in the immediate future, share prices of the listed companies have been decimated, with valuations at rock bottom levels relative to history. As such, it can be suggested that the weaker fundamental environment has already been discounted by share prices in the listed property sector. Finally, let's talk about gold. With the fundamental driver for the gold price being the opportunity cost of holding a non-interest-bearing asset, it is no surprise that US real interest rates have been the dominant determinant for the US dollar gold price in the last 2 decades. Based on the current level of US real interest rates, the predicted value of the dollar gold price is only slightly above its current actual spot level, providing a neutral tactical signal for gold exposure. However, we maintain that there is a strategic rationale for gold as a portfolio risk diversifier due to its safe haven characteristics during risk-off global periods, as well as its limited correlation with other asset classes in a portfolio. So let's summarize our thinking about 2021. Firstly, the interaction between the 3 Ps, pandemic, policy, and politics, will largely determine the outcome for the global and South African economies and financial markets this year. And secondly, although the balance of probabilities points to a conducive environment for risk assets like equities in 2021, we have to acknowledge that there could be sporadic downside risk for these assets during the year if there are hiccups in any of the 3 Ps. We will specifically monitor the trend in global excess liquidity, as this has been the main positive driver for financial markets in the last year. Thanks very much for listening, and may 2021 be a healthy and a happy year for you and your families.
Next up is Fabiana Fideli, the Global Head of Fundamental Equities at Robeco Asset Management. She will be zooming in from the Netherlands, and she'll set the scene for the year ahead and give us a global outlook for 2021 across equities and fixed income.
Hello, everyone, and thank you for your time today. I would like to take you through the global investment outlook of Robeco for 2021. A number of takeaways. First, vaccines, central banks, and government stimulus will support the macro recovery in 2021. In all of this, equities are our favorite asset class. Within equities, we favor emerging markets and North Asia in particular. In fixed income, we prefer credit to government bonds. And then an interesting phenomenon that we witnessed in 2020, probably because of the increased retail participation, we've seen an extreme polarization between stocks that had very clear and well-known brand names or clear and well-known stories, and the rest of the market. Such extreme polarization provides significant investment opportunities for active investors. There are also three clear long-term trends that we're seeing and to which we believe investors will have to take exposure to: China, sustainability, and a smarter type of value. In all of this, we need to stay selective. Country location and stock selection will remain key. When it comes to how the economies will recover from COVID, it is really about the policy trilemma. And this is actually something that was first mentioned by Mohamed El-Erian. Policymakers are confronted with a trilemma between public health, the economy, and personal freedom when it comes to managing the COVID outbreak. The solution to this is the vaccine, and the timeliness, the effectiveness, and the return to a new normal will shape 2021. Our base case is based on 4 elements. The first one is that additional vaccines are approved in the first half of 2021. We've already seen some. The global distribution is largely achieved, but not without temporary hiccups and setbacks, and we've seen some of those ones in Europe. And some social distancing will stay. The fiscal and monetary policy will remain very accommodative with a high degree of mutual cooperation. Importantly, the outbreak has been a disinflationary shock, but as economies reopen and continue to recover, we're going to start to see inflation. There has been a lot of talk about this. Low levels of inflation, particularly as they're connected to recovering economic outlook, are actually positive, particularly for equities. Last but not least, the result of US election has been a Goldilocks for equity markets in particular. The blue ripple, the victory of the Democratic Party with a relatively small majority in Congress, means more fiscal expenditure, but less of expected increases in taxes. In all of this, here are expected returns for 2021. Our favorite asset class is equities, followed by commodities. We also like high yield, but we do recognize the risks, and I'll just talk about them very shortly. We also like emerging markets that our least favorite asset class is government bonds. When it comes to the fixed income outlook, we like the fundamentals, the macro fundamentals, and we also like the technicals. There's a lot of liquidity in the market that is chasing yields, but we're cautious on valuations. We've all seen spreads compressing back to pre-COVID levels. When it comes to credit, we prefer investment grade credit, although we are neutral on it. And although we recognize that high yield does present opportunities for higher returns, we are cautious on the risks. And in terms of sector, we like financials. We are neutral on non-financials. And from a regional standpoint, also in fixed income, as in equities, we like emerging markets. As I said, in high yield, we have some concerns. On these two charts, on the left-hand side, you see the number of European zombies. Zombies are companies that have an interest coverage that is less than 1 time, so they can't really repay their interest expenses out of their cash flows. This is at a multi-year high. And on the right-hand side, you see the distress ratio defined as the percentage of high yield securities yielding above 10%. Also, this is the lowest we've had since 2008. Clearly, you are not being repaid for the risk when it comes to valuations. Let me now spend some time on the equities outlook, which is clearly about our favorite asset class. The first, if you want, and most important element to monitor for the equities outlook is COVID-19. And we should shift our attention now from infection rates to vaccination rates. We favor EM and is followed by Europe. And we also see some interesting but selective opportunities in Japan. Within emerging markets, we like North Asia, but we're also starting to see opportunities elsewhere. As particularly the reopening trade has begun, you do see other emerging markets also presenting opportunities. And also, as you you think about commodities, a lot of EM markets are exposed to commodities. We talked about the extreme polarization of headline versus fundamentals, and this is an area that we really should pay attention to. When it comes to sectors, we like technology. We don't like the high-flying digital COVID defensive sectors. We like other areas in technology, particularly hardware and less known companies. We like the enablers of sustainability. Sustainability as a theme has done very well in the market, but it's not all about renewables. There's a whole host of companies that support with the services and their products, the power generation and the renewable companies, and there's a lot of opportunity there. We like materials, healthcare, and discretionary consumption. And last but not least, we do like financials, but we're sticking to the higher quality balance sheets. Now, one pushback that I often get from clients when it comes to equity markets is that they have already done so well. Well, what you see on this slide is that, yes, some of them have done extremely well, and that's really the US, particularly NASDAQ. But other large regional markets as the MSCI EM, China domestic, or the stocks Europe 600, actually they're just about or even slightly below previous highs. So the key here is, how do we choose the markets that we want to invest in? Well, from a regional standpoint, the relative performance has coincided with a forward earnings gap. What I mean here is that if you look at these four charts, they show two lines. The first one, the black line, is the price of the index of that market versus the MSCI World. And the second line in orange is the forward earnings expectation for that market versus the MSCI World. You see that the two lines actually have a very similar trend. So if you find a market where the earnings expectations are actually trending better than other markets, you probably find also the market that will do best from a pricing perspective. And so when we look at that, we look at this table, we realized that the US, which until now had clearly the strongest earnings from a global standpoint, and for which we paid a significant premium, you see here a PE of 24 times, doesn't have that privileged position on the earnings front anymore. When you look at the earnings growth between 2020 and 2021 of the large regional markets, actually the US doesn't look as attractive anymore. And as long as these earnings expectations stay where they are, then clearly the US doesn't warrant the valuation disparity with other regions. And that's why we like equities in other markets. And this brings me to the next point, and that is the headline effect that we have seen. What you see here are two charts. One is developed markets on the left-hand side and emerging markets on the right-hand side. The red line are the top 5 stocks performance, and the yellow line is the rest of the index. And what we have witnessed in 2020 has been this extreme polarization between the top 5 famous brand names and the rest of the market. In 2020, the S&P 500 top 5 stocks were up 65%, and the other 495 were up 10%. In emerging market, just 2020, the top 5 were up 47%, and the other 1,375 were up only 11%. This means that as active investors, if we look for those companies that have strong fundamentals that can and are driven by similar trends as the top 5 and many others that are exposed to the economic recovery, we can actually find some really strong alpha opportunities. And this brings me to the longer term themes that we believe as investors we should take exposure to right now. The first one is China, which we believe is destined to become a core allocation in all investors' portfolios. The second one is value. We believe that value will continue to return. You've seen it more recently since November, but we believe that we have to look for a smarter type of value. And the third one is follow the green signs. During COVID, governments have increased their fiscal expenditure, particularly on the environmental side. And as equity investors, we should acknowledge that and follow that trend. So on China, you can see on this chart on the left-hand side, if you put together China and Hong Kong, we're talking about a market that is the second largest market in the world, 1/3 of the size of the US market, by far larger than other markets. We can't ignore it. And on the right-hand side, you see the inclusion of China in the MSCI index. This is increasing, it's also increasing because the government is increasingly opening the ability of foreign investors to invest in the domestic market. And there's a lot of interesting exposure to take in that market. The second point that we made was about the rotation into value. We believe the rotation is here to stay. We believe that as the reopening trade takes more, becomes more evident, cyclical stocks will do well. But we also believe that we have to be careful. We are in an age of increased digitalization. We are in an age of increased services, content, where manufacturing is a lot more now about software than hardware. So when we look at stocks, no matter which sector we look, not only digital sectors, we really have to look for those companies that are able to innovate and stay, at pace with times. And then my last point on sustainability. We've seen in 2020 that we're not the only one who have noticed that sustainability is a theme to stay. If you look at this chart, the dotted lines are the inflows in equity funds globally, in European and in US funds for mainstream funds, so with no real ESG content. The solid lines are actually the inflows in markets that have, or in funds that have a ESG content, so what we call sustainable funds. And you see that sustainable strategies actually have had far stronger inflows than the rest of the mainstream strategies in equities. We believe this is a trend that is destined to continue, and it is a trend that investors should take exposure to, as governments will continue to pour more fiscal support into environmental protection. And with that, I conclude, and I thank you for your time.
We have a panel discussion moderated by Sonia Saunderson, the Chief Investment Officer at Momentum Investments. Now, she'll be asking our panel from South Africa and the UK what they think are the key trends and the priorities shaping the conscious investment manager of the future.
Welcome, everyone. We certainly have emerged from 2020 with a lot of challenges. Everyone in our audience has in some way been affected by the COVID-19 pandemic. We each either know someone that has been affected, or we have personally been affected by the virus ourselves. Our thoughts and prayers are with everyone who has struggled as a result. Sometimes, though, when we are in the middle of hardships and challenges, we tend to forget that there are also good opportunities amongst the chaos. New ways of working, new businesses, new business models are all being revolutionized and create the next wave of innovations, improvements, and investment opportunities. With this as a backdrop, how are we going to navigate the markets in 2021 and beyond? This period will undoubtedly hold surprises for us, but we will also be reminded that consistency and a disciplined investment management approach are and remain the best course of action. So let's maybe today have a bit of a conversation about what our panel thinks will play out and how they are positioning themselves in their respective portfolios. Joining me today is, first of all, Andrew Hardy. Andrew is the Investment Director for Momentum's Global Investment Management team in London. Ian Scott is Momentum's Head of Fixed Income. Lawrence Koikoi is a Senior Portfolio Manager within our property team in Momentum Investments. And last but certainly not least is Motlatsi Mutlanyani, who heads up Momentum Investments Alternative Investments team. Andrew, Jeremy Grantham, one of the world's most famous value investors, has in January in his newsletter described the market as one of the biggest bubbles that he has ever experienced in his lifetime. And in fact, he even compared it to the 2000 tech bubble. If one looks at some of the tech companies globally, it certainly does seem to be a little bit overbaked. I actually read somewhere that there were more than 300 US initial public offerings or IPOs, and half of those were special purpose acquisition companies, essentially intended for more tech IPOs. Andrew, with that backdrop, what do you think this means for us in the global portfolio management context, and how do you navigate your portfolios given this backdrop?
Sure. I think Jeremy Grantham and GMO's concerns about valuations are certainly valid, and indeed the points you raise about examples of excess in markets are a cause for concern. Ultimately, though, I think they should serve as warnings to us as investors and reminders of the need to focus on fundamentals and the need to be highly selective in portfolios. Overall, our view is that this year should be a very good year for equity markets, and it's key to stay invested and particularly be exposed to the strong cyclical recovery that we envisage coming over the course of this year, and not to be too sidetracked by some of those more specific goings on in narrower parts of the markets. Just on the point of SPACs and IPOs and the like, there's certainly worrying going on there, and particularly signs of, I guess, excess liquidity sloshing around from the huge stimulus, the low rates environment that we're in. On the SPAC side of things, I saw one really interesting example of a recent IPO in the US, a business called Affirm, which is an internet-based consumer finance company. They get about 30% of their revenue from financing Peloton purchases, which of course is booming at the moment due to lockdowns and the like. But their valuation is 1/3 that of American Express already, despite having only 1% of the revenue generation. So it seems like a massive valuation disparity there. There's a huge amount of hope built into that share price, and I would say a massive amount of valuation risk for investors. And then on the IPO side of things, I saw some stats about the US market recently about, I think nearly 60%, the run rate at the moment that we've achieved in 2021 year to date, even early in this year, we're already at 60% of last year's total IPO figure. And at this rate, we might exceed the previous peak of 1996. More worryingly, almost 90% of IPOs last year were actually loss-making, which is the highest figure in over 30 years of data. So definitely signs of excess that we should be wary of. And a reminder that excess liquidity on the scale we've seen today can give rise to irrational behavior in areas and potentially some bubbles. But we don't think it's a bell ringing for the market top, more call it a warning shot after a long bull run in markets, and a reminder of the need for careful diversification in portfolios. I'd say the levels of valuation disparity within markets are actually wider than ever. So you've got parts of the markets that are very expensive, but also parts that are particularly attractive. And that comes through to some extent if you look at the index concentration as well. In the US, you've got the top 5 stocks, which represent now 22% of the index by market cap. It's the highest in recent history, and they amount to $5 trillion in market value overall. That's more than double the value of the entire UK stock market, hundreds of companies. And without being parochial, I think it's the UK is a great example of an undervalued market where there's a huge amount of opportunity, hundreds of high quality businesses with a great heritage, and on very low valuations. And that's underrepresented in global indices and a lot of portfolios as well. It's less than 5% of the MSCI World Index now. But we think the potential going forward is very strong there. I guess the pandemic of the last year has really exacerbated the divergence in fortunes between the winners of the last 10 years and the losers. So we see a bit of a snapback coming, and value-oriented strategies should outperform in that environment, particularly more cyclical sectors, which have the largest recovery potential, whereas growth stocks, tech industry, or at least large parts of thereof, are probably likely to underperform if we get the widely expected recovery in economies and corporate earnings that seems likely later this year. Just on GMO, I mean, they've been saying broad equity markets are expensive for many years, but their message also is similar to ours in terms of at the headline level, markets are expensive, but beneath that, there's a lot of opportunity in value stocks outside the US particularly, and in emerging markets. And just on the point on the 2000 tech bubble, remember that although that was very bad for many overvalued tech stocks, it heralded the start of a near decade-long upswing for large swathes of equity markets, particularly value and small mid-cap stocks. And I can see similar happening from here potentially. We've maybe already seen the beginning of it. So overall, in summary, I'd say the opportunity for active management is really rich today, whereas for passive strategies, I think there's a lot of elevated risks there due to the concentration in the winners of the past 10 years. And key for us is to take an active and well-diversified approach to investing globally. Don't be overly concentrated in the winners, in the fastest growing stocks of the last few years, rather look where the potential is going forward and have a balanced exposure across different equity styles. I think it's much more important to have that now than it has been for several years.
Thanks, Andrew. That sounds like very good advice. You referred to the fact that there's excess liquidity, and we've been in this extreme period now for a while. So to what extent do you think the market is driven by expectations of liquidity and low interest rates? And how do you think companies are positioning themselves in this environment? And can they continue to grow should this environment change?
Sure. Yeah, it's a huge factor that's supporting overall valuations for equity markets and indeed all risk assets. Interest rates being at these interest rates and bond yields at multi-century all-time lows, and rates likely to stay ultra low for the foreseeable future, really. It provides massive valuation support, so it's critical at the overall asset allocation market level. I'd say we'd see that rates staying very low for the foreseeable future from here. Markets have become a little bit more concerned about inflation risks and potential tightening early on this year. I think that's somewhat premature from our point of view. Central banks around the world really are committed to maintaining huge asset purchases and interest rates at or very close to the lower bound, which is zero or a little bit below in some, for a long time to come. And there's no prospect of increases this year, we don't think. And the Fed's decision recently in late 2020 is also key, where they moved to average inflation targeting. It shouldn't be underestimated. It means that they're willing to let the economy run hot for a period to achieve their inflation target, and very much underpins this case for lower for longer. And the ECB is likely to follow a similar sort of policy. There's risks around that argument, of course, and that gets to some of the points that GMO make about valuations at the overall market level. But I think it's, coming back to my points before, I think it's actually the long duration growth businesses that have benefited most from this low rate environment. And actually that's been a key factor there overall. But also one should remember that low rates doesn't necessarily translate into high equity multiples. It's not been the case in Japan for many years of decades of low rates. But I guess come back to the other part of your question, I'd say two key lessons from history that we should remember are, one, it's earnings that drive returns over the long term for businesses. It's not a change in valuation multiples necessarily over the properly long term. And secondly, good businesses can thrive almost regardless of the economic backdrop. And I think too many investors get shaken out by short-term macro concerns, which ultimately hardly register over a sufficiently long-term horizon. I'd say the key for us is to keep clients invested through building in true diversification to portfolios in order to mitigate the volatility risks that can derail markets in the short term and can derail investors from their journey. So very much invest for the long term, focus on buying good businesses at reasonable prices and stay well diversified. I think that's the best way to mitigate those risks.
Okay, so certainly a key theme that you keep highlighting. and important for us to remember is to stick to the disciplined process. Let me move a little bit closer to home maybe. In South Africa, we've had our own challenges of several economic growth setbacks, with amongst others lockdowns we've experienced and sluggish growth, all of it resulting in deterioration of sovereign credit quality and risks in the state-owned enterprise sector. Ian, you know I'm coming for you next. What does that mean for our fixed income portfolios, and how are you positioning things with this backdrop?
Yeah, thank you, Sonia. It is a tough environment, but in tough environments is where we find the best opportunity. I think it's typically that valuation methodology where we say, look, not all SOEs are created equally. There are opportunities. But coming back to the first part, yes, we are in dire situations with our fiscal policy. Government finances don't look great. It's deteriorated significantly over the last 10 years. I mean, we've witnessed the sovereign downgrades. I think that's out there. We've seen that our yield curves steepen significantly now. Thinking about Andrew's world where yield curves are very flat, and he's talking about zero or negative rates. Just to give you an idea, in South Africa, we've got probably the steepest yield curve in the world, where it starts around 3.5% and it ends around 11% now. It's not many times in history. Some of us that's got more grey hairs remember 1998 when Chris Stals took rates to 25%. Now, we're in a very similar situation that, having a 7% steepness in the yield curve when growth is literally around 1% on a long-term average and inflation is around 3%. We think there's very good opportunities in South African government bonds. And yes, you would say, sure, every day we read the papers and we read the social media and we think South Africa is the worst investment destination. But, that's always the trick with investments, is to put your emotions on one side and say, but what is actually in the price? Is the price or the yield reflective of bad news? And we believe in South Africa it is. When the yield curve is 7% steep, there's good opportunities for real returns in South Africa. We've seen it, for example, over the last 3 years that government bonds have returned around 9% when inflation was probably around 3%. Now, it's not often in history that you find 6% real returns from a asset class like South African government bonds. To the second part, yes, SOEs, they are troubled. We read about Eskom every day. As I always said, that's why bonds are the most interesting asset class, because there's no Eskom in equity markets or in the property market. But yes, we believe it will be bailed out in a meaningful way. It's got the best government guarantees and it literally is too big to fail. It's not the same for all SOEs. But what it would make, what is important is that I think we need to look at management scores. Especially last year, when we saw the default of Land Bank, it made us revisit our process and say, Andrew talked about bad businesses surviving through bad times. But, Land Bank is probably one of those examples where you can say, well, it's actually a very good business. It supplies 30% of the agricultural loans in South Africa, yet it was poorly managed. So what does it mean? It probably doesn't have a great management team. In terms of our ESG policy, we would actually say, look, we probably have to put a higher weighting on the governance part. How do we interact with management? What is the capital allocations? And it's to Mutlatsi's world as well, because he's much more into that SOE and in infrastructure world. How do we think about management teams? Because the quality of the balance sheet and the quality of the income statement is only one half of that coin. The other half is, what is management actually going to do? What is the path forward? So, I think it's a lot more focused around sustainability and governance when we think about South African fixed income and SOEs, credits, and to Lawrence's world as well. I mean, what we've seen in the property market as well, there's going to be a lot more focus around management actions, capital allocations.
Okay, well, certainly seems like a challenging environment to navigate. And of course, we know that foreigners are also a big driver of what happens in our bond markets. Foreign investors have been large sellers of the South African bonds the last few years, in fact. But they do remain a significant holder still of South African bond market. How important do you think that is for what's going to play out in 2021 in the bond market? And again, how do you position the portfolios accordingly?
So yes, as much as we say foreigners create volatility in our markets, they are a very important player. So just to give you an idea of the stats, so when we were still part of the Weekby index in 2012 up to 2018, foreigners owned about 42% of the South African government bond market. Obviously, with all the downgrades that we've seen over the last couple of years, they reduced that position. And last year, with the final ratings downgrade into junk or high yield status. We saw them reduce their positioning from around 37% to below 30% currently. So definitely big swings. So yes, you lose 120 billion of bonds in South Africa or investors. It is a big number. The good thing is our yields are high. So luckily we saw the South African pension fund industry, the unit trust industry, the insurance industry actually come out and buy those bonds that the foreigners were selling. And that's why we didn't have this massive sell-off, let's say akin to 1998 in the bond market. But they can be a big factor. As Andrew said to you, when rates are zero and suddenly you have a liquid bond market and a swap market, and we know the rand market is very liquid. If I was sitting in London and I was a fund manager or in any place in Europe or the US, I would say, well, there's this place in South Africa. If they can just get their government finances in order and show us that they'll actually cut the deficit over a period of time, they're not going to fix it in 2021 or 2022. But if we can work out that, government will keep control of the fiscal deficit out to 2026 or 2030, South African 10-year yield sitting close to 9% looks very attractive in a world where rates are literally zero. So, yes, if we can just fix some of our policies, and I think that it's highly fixable, I think foreigners can come back into the South African market in a meaningful way. So, yes, over the last 3 years, we've seen them as major sellers, but, year to date in 2021, we've actually seen them as very aggressive buyers. And what was quite interesting is they weren't necessarily buyers of what we call the front end or the short end of the curve. They were actually buyers in long duration South African government bonds. I'm talking 2035 out to 2048. We've witnessed that foreigners suddenly become buyers of South African bonds. Now, we just need a bit of fiscal consolidation, good solid policy, and I can't see why foreigners will not buy South African bonds. It is very attractive.
Of course, a view is also held that the South African Reserve Bank is keeping interest rates higher than it would as it factors in the fiscal situation in South Africa. This helps keep South African interest rates attractive on a global level. So even how do you think about the trade-off then between default and yield? I mean, what does default actually mean where monetary supply can be expanded and this be done without risking inflation? How do you think about those?
So let's start with the SARB, and it's right. And I think the SARB by nature is a conservative animal. I think forever and a day, the SARB has always been running high real rates. It always wants to protect the currency in a sense, and it doesn't want to get to the knee-jerk reaction of 1998 and suddenly have to hike rates again. So I think the SARB this year will probably get into a position where it's going to feel more pressure, where, as Herman has said to you, that we think that inflation could go to 4 or 5% this year, but cash rates are sitting at 4% and the repo at 3.5%. So theoretically, there's going to be a pressure building up in the SARB, but at the moment, we think they'll probably keep rates steady for this year. But the SARB wants to have positive real rates, meaning rates above inflation. Now, getting to the default part, now that's quite hard. So that's why we think it's quite important that fiscal comes and plays with monetary policy. I think the SARB has probably shot most of their bullets by cutting rates 300 basis points last year, adding liquidity into the bond market. You need that fiscal consolidation in the government budget. But yeah, there's a high risk of a sovereign event over the next 3 to 5 years if we don't actually arrest. Remember what the Minister of Finance said, they've got the active scenario and the passive scenario, and somewhere we've got to line up between the active and the passive scenario, or there will be a fiscal event. I think the risk flag is out there when South Africa's debt to GDP gets to 100%. If we don't arrest it and we're only growing at 1%, there could be an issue. So do yields compensate you for a default scenario? Well, probably not, because what does a default scenario really mean? We're not saying default. We say there's a risk of a fiscal event, but we are saying that a lot of negative news are already sitting in the South African yield curve. So poor fiscal numbers, bad Eskom, probably other bad SOE management, more contingent liabilities, probably, we don't know, more government guarantees, we don't know. But yes, that sits in a number. But is a default price? Probably not. But we don't say that is our base case scenario. But if you want to talk around default scenarios, well, then the South African bond yields will probably have to go into high double digits. Just to give you an idea, so in 1998, when the prime rate went to 24%, the 10-year bond yield probably went to 21%. So those will probably be the numbers. So that's not sitting in the price. So not even the bond market is saying to you there's going to be a sovereign default. But in a default scenario, you need much, much higher yields to compensate you for the default, but that's not the base case. So we are going through troubled times, but definitely not a default scenario. I think it's also quite important to understand that we don't have the ability to create monetary stimulus in terms of a QE. We can't print money. We're not a funding currency. The rand is a local domestic currency. It's not a funding or a trading currency in the world. So we can't really do QE. We can't add the monetary stimulus. That's more in developed markets. In EM, what we've seen is the SARB cuts rate. It buys bonds on the secondary market, and it will support the market as far as it can. Government will do fiscal measures to help the economy. But true QE in the sense of the word, probably not in South Africa. So we're not too concerned around money printing in South Africa, or what we call the swear words as debt monetization, meaning we're just letting the printing presses run. I don't think we're going to go there. And that's why we believe that a lot of the negative news sits in the yield curve. It's not to say that it cannot move higher, but yeah, we think there's good opportunities to have high real returns in South African fixed income at a low risk level. And that's why we position positively in terms of the yield curve, in terms of our duration positioning. And we think for investors, it's a good alternative to these asset classes that's really overvalued. You heard from Andrew saying that global assets are very expensive. And we always say, well, the best opportunities are obviously found in markets where the valuations are low and expectations are low. And we believe that South African fixed income is one of those asset classes.
So let's maybe move a little bit to the property side, where valuations are certainly also always top of mind for investors. Looking at occupancy rates and the link between the footfall in shopping centres and growth in the economy, there's certainly been much speculation about what South African growth environment will mean for South African property prices, and especially the asset class, I suppose, Lawrence. You started last year, you and the property team, classifying companies completely differently, actually at the end of 2019 already, and you started classifying it according to their ability to navigate through tough economic environments. And you classified it as core companies that really will be able to go through those cycles in a professional manner, and they will survive and they'll do very well. And then the more tactical companies that probably will struggle a little bit, and then the non-core companies that probably will have a very difficult time to get through that environment. With that backdrop, one would have expected actually one-way traffic in 2020, given what's been happening with COVID-19 and the pandemic, but it actually played out completely differently. So just what happened last year, and how do you think it's likely to play out going forward, and how do you think, with the backdrop that Herman also sketched, what is going to happen in your asset class?
Thanks, Sonia. You're quite right. Last year and this is before COVID, we started classifying companies in terms of core, tactical, and non-core. Just seeing the pressure that was facing the property market in SA due to the weak economy, and then COVID hit. And unfortunately, the whole market couldn't escape the sell-off of COVID. But within that context, we also started noticing the divergence in performance between the core and non-core stocks, where the core stocks outperformed the non-core stocks. I think for us, core definitely means well-capitalized businesses with limited competition from both physical retail and online retail. And non-core would typically be companies with poorer portfolios, and also amplified by the high level of gearing. You can make money both with core and non-core, but when you start talking about non-core, you're really talking about playing the re-rating and playing the share price, because the market can be quite volatile, where it can be one day excessively happy with a certain company, and the other day it will be excessively negative about the company. So you can definitely then take an opportunity to make money from there. And then on the core companies which haven't really dipped in the pandemic, like the non-core, you're really talking about companies that are supported mostly by structural changes in the sector. And because they are not as volatile and probably not as cheap face value, I think the one way to really make a good investment in that is just to wait for a good entry point in terms of price. And the opportunity within the non-core is really engaging with management and really seeing if there is a credible recovery plan in place. And absent that, I think it's quite risky. And that's why we prefer the core stocks, but depending on the price. So this market offers great opportunities for investors to make money. But our strategy is really looking for good companies and looking also to buy those good companies at attractive prices.
We, of course, also saw in the last quarter of 2020 this phenomenal rally that listed property had on the back of all the positive news that came out about vaccines globally and eventually also coming to South Africa. The rally really particularly benefited shares that fell out of favor during the 2020 pandemic period. Do you think this trend is likely to continue? Do you see certain stocks coming to the fore as a result of the positive news on vaccines?
Yes, certainly, because on the vaccine news, and this is Q4 2020, we started seeing the stocks that were hard hit rallying. But when one looks at it, some of these stocks were actually they fell out of favor pre-COVID, and then COVID just accelerated that. We just think post-COVID, the challenges that some of these companies face will not unfortunately disappear, just given the economy and just given the debt problems that they face. So a lot more needs to be done. Vaccine news is positive. And we just think some of these weaker ones will continue to trade at a discount, probably be more volatile than the stronger ones.
Now, all of us have seen going to some of the shopping centers that retail centers generally have been experiencing a lower footfall, which has partially been offset by higher spend per shopper and a clear indication of a preference for community retail centers of super regionals. How do you perceive the retail market adapting to this phenomenon?
Yeah, it's a tough one, but our observation is, food and entertainment in shopping centers was meant to fend off the onslaught of online shopping. This is pre-COVID. But now COVID hit and it has actually taken that lever away from the retail landlords. So it really calls for tough decisions from landlords to start disrupting themselves before being disrupted or while they're being disrupted. We've seen in the US where some of the big department store space is being converted into last mile warehousing logistic facilities. I think those are very important trends for SA landlords to heed. And probably landlords shouldn't be too sanguine about their low online penetration in SA.
There's also been an uptick in interest in office to residential conversions that we've seen in the property sector. Do you think this is a material trend? What other trends are you picking up that could also tell you what's going to happen in the sector in this year of 2021?
Office has certainly been a problem if you just compare it to the other subsectors, retail and industrial. And traditionally, it's had higher vacancies. I think it sits at 13% according to the latest SAPOA numbers. But we are starting to see some activities where private developers are taking some of this office space and converting them into residential. But unfortunately, that's not enough to bring that 13% down. While it's positive, I think we really need to see a strong and a sustainable rebound in the economic growth to really absorb this massive space that's available out there.
Okay. So another interesting uniquely South African phenomenon has really been our government asking us to invest in infrastructure as an industry to help really restart the economy and make sure that we start growing again. That in itself could pose an interesting fiduciary challenge to play off over the long-term societal economic benefits versus your fiduciary role towards clients and their retirement goals. Matlatsi, you look after our real asset programs. You certainly have thought about what COVID-19 means for the real asset space. But how do you think about this phenomenon, especially on the back end of COVID-19 and what it's posed for our environment?
Thanks, Sonia. So 2021 is all about recovery, right? We have a new president in the US. We have quite a collection of vaccines that are being distributed. So things seem to be on the up. And this is no different in the alternative space. But obviously, as was said earlier, and Andrew also said it, that we don't expect the recovery to be even, right? We expect that there'll be some winners and there'll be some losers, right? And we'll talk about that just now. But now, I think more than ever, I think it's important to understand, as with other asset classes, real assets are not all built the same, right? So at portfolio level, they may look like they have similar features. The themes are common, but they all have different drivers, right? And the risk-return profile is very different, right? And if anything, the lockdown has actually accentuated some of those differences within the real asset portfolio itself, the real asset space itself. But having said that, I think it's also important to realize that some of the initial effects will obviously dissipate as lockdowns get eased, as vaccines get distributed and things like that. So it becomes increasingly important to be able to differentiate what's a temporary or initial effect and what's a more long-term and structural effect, right? And from our perspective, the way we look at these things, we look at them, I guess, in three broad terms. The first one being risk, the second being diversification, and the third one then being leverage, right? So risk, I guess, is more or less what you were talking about with Lawrence now, that, initially when you looked at some of these assets in the real space, we always said they're assets that are very safe. So your cash flows are very predictable, very stable. And then there are others where the cash flows look great, but you're not quite sure about what's going to happen. And then when we build a portfolio, we obviously put them on the risk spectrum according to those features. That was before the pandemic. Things have now changed. So assets that you thought were very stable, so for instance, if you look at office, if you look at physical retail, which obviously make up the real space too, right? You had reliable tenants, you had very stable cash flows, and now we can't say that anymore. So there's certainly been a migration along the risk spectrum, right? And assets which were sort of like borderline have now come to be core assets because they've actually shown that they're very resilient and have made it very well through this period that we've been in. So risk then becomes even more important within the different elements of the risk asset space. So that's what we're increasingly spending a lot of time in trying to differentiate exactly what those risk drivers are so that we position assets perfectly on the risk spectrum. Right, and then the second element then is about diversification. So in the same way that it's always a good practice to diversify within your portfolio in general, it's also good practice to diversify even within the real asset space. The particular South African phenomenon right now is that renewable energy seems to be the mainstay. So that's where most of the capital is going. And there are obviously a number of reasons for that, and very good reasons too for that. But what ends up happening is that, and not just for us, but also obviously for our competitors, is that there's a lot of concentration within the renewable space. So we think it's important, obviously, to try and diversify away from that, right? And so we are looking at other things outside of renewables. So we're putting in our portfolios, we're looking to put water assets in there. Obviously, gas as I guess, a third layer of power generation. We're looking at doing that. And also alternative energy, such as biomass and other forms of energy generation that we're looking to put within our portfolio. So that's obviously quite important within our space. And then lastly, then it's about leverage. Now, you obviously know that most of our renewable real assets are big tickets assets, right? So leverage is quite an important element of that. But given what's happening now, it's not always clear that some of those assets will be able to generate enough cash flow to be able to support that in the instance where they come under stress, as they did in the last 12 months. So we obviously need to understand that very well to see how, running different scenarios, how they'll be able to withstand that and whether they'll be able to service their debt. So I guess in closing, to come back to your question, the important thing, I guess, is what we are now focusing our portfolios at. And we think that of the winners and losers, the three definite winners in this space are obviously going to be renewable energy, for the reasons that I've mentioned. There's going to be ESG and impact-themed investments in infrastructure. And then thirdly, it's going to be e-commerce and digital infrastructure. So that's where we think that assets that have done well during the lockdowns and that will do well even after the lockdowns is going to be around those three areas.
On the first day of his presidency, President Joe Biden signed a raft of executive orders. Among other initiatives, he's recommitted the US to the Paris Climate Change Agreement, as well as membership to the World Health Organization. These are, of course, important developments and another very clear example and a signal, I think, to the world that ESG has become much more important. You've touched a little bit on how that plays out in the alternative space in South Africa and real assets specifically. Andrew, just quickly over to you. Have you seen a big change globally as well in terms of the ESG responsible investing theme? Are clients asking for something different? And how have you implemented any particular changes in the portfolios as a result of COVID-19 in this space?
Yeah, sure. So COVID accelerated so many global trends, didn't it? And the move towards sustainable investing, more consideration towards ESG factors is definitely one of those. It was already one of those, I would say, inexorable trends that wasn't going anywhere, and for good reason, but it's definitely been accelerated by COVID. We first really observed like a global awakening, I'd say, to the debate on climate change in particular in the year or so prior to the pandemic. If you remember back, there were a lot of extreme events, fires, storms, flooding, etc. You had the Extinction Rebellion capturing headlines as well, and so climate change really got the heightened attention that was long overdue, I'd say. But of course, it's just one of the group of factors under a broad umbrella of sustainability considerations, which the investment community and the world is much more alive to now. COVID has accelerated particularly the E and maybe more so the S side of things, I would say. Clearly, it's impacted how we live our lives, and certain aspects of that will stick. I hope I'll still get the occasional invite to come down for events like this in person, but business is going to incorporate more of this kind of digital side of things, virtual, as opposed to and business travel, I think, will suffer to some extent. So clearly benefits the E side of things. And I think everyone is keen to make sure some of that sticks, some of the benefits for the world. Huge levels of inequality have been exacerbated again. So focused minds on the need for a just transition and that's as well. And then of course we've got massive fiscal spending, huge stimulus, and that's being, I'd say, disproportionately channeled towards green projects and projects that help deliver on the sustainable development goals. Digital infrastructure example was just mentioned, things like that. I'd say a clear acceleration. What have we done? We've over the last few years, we've been building out our offering of funds and solutions in order to include dedicated solutions that are mandated to maintain higher standards around ESG issues to better meet the evolving needs of our investors. But it affects all funds and all solutions. ESG factors represent real risks for businesses and investments, and absolutely need to be incorporated into all investment decisions. So we very much take the integrated approach in terms of how we factor in ESG. And I'd say the big change that I think we've seen is other investors, advisors, and then clients and the like, kind of evolving their thinking a little bit more and taking it to the next level. Beyond it, in the early stages, I think it was much more biased towards negative screening and exclusions, which has a place, but with much more believers of the integration camp for some of the reasons I mentioned and many more that I won't go into now. But it needs to be factored into everything you do. Negative screening can be part of the solution and impact investing as well, but it really needs to be embedded in everything. And that debate, I think, has moved on a little bit, and people are a bit more alive to that. But there's still a long way to go, I think. And there's so many different variations of how our industry caters for the needs of people who want to emphasize the sustainability side of things more. And it's incumbent on investors, I think, to make sure they're getting what they want from their managers. So good progress, and welcome acceleration on that trend. But I'd say true success will be when we don't talk about it anymore, when sustainability becomes normalized and really embedded. And that's I don't know, many years off still, I'd say.
But let's see, listening to what Andrew is saying about ESG in the global context. I mean, in South Africa, aside from the very South African themes that you referred to in the real asset program, we've got a very real need for societal impact. And if you think about the sustainable development goals that we signed up for, are there any particular examples of things that you're thinking of or working on that sort of addresses that uniquely South African need from a portfolio perspective?
Yes. So, I mean, from our perspective, we obviously think that real assets are the perfect instrument to use to achieve the kind of goals that we've set of ourselves from an impact perspective, from an ESG perspective, and from a general environmental angle, right? And that makes sense because real assets itself is already a thematic, right? If you think about it, right? That is a very specialized area within the investment area, and it drives specific agendas, right? And that's why we think that anybody who goes into long-term investing should definitely align with one of these goals, right? And that's the benefits of real assets, because there are obviously diversification benefits, but importantly, to your question, is that it allows us to align our long-term investment strategy with either SDGs, with ESG, or with any other goal that I guess an investor would have, whether that's a technology goal or a water goal or a, whatever that is. ESGs, real assets are the perfect instrument for that. So how are we implementing it in our portfolios? A number of ways. We are certainly structuring our portfolios to actually be impact, right? So we are setting up parameters where we can actually measure impact and be able to show a delivery from an impact perspective in the long term, right? And that's the way we think that it's the most effective to be able to say we do impact investing. Because it's not like back in the late 90s and early 2000s, where everybody was doing sociable investing, right? Social responsible investing, where everyone was doing it, but no one was actually measuring it. So how do you know that you actually are delivering? So the intention with impact is actually to make it deliverable and to show that there's actually additionality, that you are contributing, and at the end there's actually it's greater than what it was initially. So we think that that's a great thing. Secondly is that we're incorporating, like most people have, but very importantly for us, ESG as part of our due diligence process in every instrument or every manager that we invest in from a real assets portfolio, right? So the ESG element is very important to the extent that our IC makes it a point that if they can't sign off on the ESG report, that we're comfortable with what the manager is doing or what the instrument is delivering, we'll obviously take it back and ask the investment team to do a bit more work on it to get it to go over the line. So, and how that's translated into the actual investments in our portfolio, the kind of assets that we've allocated money to are student accommodation. So as everybody knows, the student accommodation for South Africa, there's a massive gap there on what needs to be delivered. I mean, there's a shortage that was measured 2020 of some 300,000 beds across the 26 institutions in the country. And that will grow to 400,000 by 2030. So this is a big gap that we can obviously use our investors' capital to be able to make sure that they can contribute to a sustainable outcome, right? And this is one way of doing that. Other areas we already, as I mentioned earlier, is obviously renewable energy. For people who are working at home, obviously, your energy use and your carbon footprint, while it may not be a big issue now, but if more people are working from home, there's definitely going to be a build-up of some sort, right? And renewable energy then, whether it's home-based or industrial, becomes an even bigger requirement from society in general, and also, from us as investors too. And so we can go in and make sure that we're able to allocate capital to make sure we achieve sustainable needs and also fill the gaps that we can identify within South Africa.
So certainly a lot more integrated approach on the ESG and responsible investing front. Let me close off by thanking our panel for their insights and for your contribution today. Thank you, gentlemen. And thank you also to the audience for participating in the conference with us. We appreciate any feedback that you've got, and we really hope that you found this insightful. Thank you.
Lastly, we've got Theodore Blanche, the Executive Head of Investment Management at Momentum Investments, who will summarize and draw some conclusions from the presentations.
Hi, I'm Theodore Blanche. Thank you for attending the latest edition of Moments with our Investment Gurus, where we continue to showcase our investment management thought leadership and portfolio thinking. I hope that you've gained some valuable insights into how our investment professionals think and position their portfolios for this ever-evolving and dynamic environment we find ourselves in. It's hard to believe, but we've been living with a coronavirus and in some form of lockdown for almost a year already. And it's been amazing to see how quickly things have changed and how we've pivoted to new ways of working. New opportunities are presenting themselves with new themes developing, and some trends that were already underway have accelerated substantially. If the last year has done anything, it's certainly given impetus to ESG factors, and it's becoming far more fundamental to how we think about and approach investment opportunities daily. With all the change and volatility around us, and with so many unanswered questions still around, there is huge value in entrusting your investments to seasoned professionals who have both the experience and the knowledge to maintain a robust and consistent approach as custodians of your investments. Having the ability to leverage global and local knowledge and to integrate this in an aligned and consistent investment philosophy is an essential part of our investment toolkit. In times like these, the need to not become too focused with short-term market movements, but to focus on longer-term goals and to stay invested is even more pronounced. We believe in continually investing and expanding our skill set and to forge the kind of partnerships you would have seen us showcase today and before with a world-class investment manager like Robeco. Some of the key takeaways from the sessions for me were, even though the world economy in general is in a better place than 6 to 9 months ago, 2021 will undoubtedly deliver its fair share of surprises, and how the pandemic, policy, and politics play out will certainly influence outcomes. Through all this uncertainty, it's important for investors to look through the short-term noise and to focus on their long-term investment goals and, critically, to stay invested. In the longer term, we know that fundamentals like earnings growth and good business models are still the main drivers of valuations and investment returns. Diversification is even more important during times of uncertainty like the present, and as in any market cycle, there are asset classes, jurisdictions, and sectors within asset classes that offer value, as you would have seen in our panel discussion. A dedicated investment team looking for these opportunities on your behalf shouldn't be discounted. COVID-19 has emphasized the importance of ESG factors when investing, and we remain dedicated to following these principles. We have a proud history, and we've been one of the early participants in South Africa in various responsible investment initiatives. The key focus in South Africa to jumpstart our economy is infrastructure development, and we believe the private and public sector should work together to deliver on the President's plans for our country. As we gradually see the effect of vaccine campaigns and through this, growth returning to the global system, it's critical to remain vigilant and to keep an open mind and disciplined approach when it comes to managing investments. Over time, I hope to show you more of our investment IP, our thought leadership, talent, and investment insights through the partnership we have in Robeco and in our local and global investment teams. We hope today's event will help you navigate the year ahead, and I trust that you've enjoyed the session with us. We look forward to seeing you at future editions of Moments with our Investment Gurus. Thank you once again for your attendance, and until we talk again, stay safe.
I hope you found this session valuable. The full video will be hosted on our website on momentum.co.za under Investments and Savings. If you watch the full session, your CPD certificate will be emailed to you shortly. Now we look forward to hosting you again at our next Moments with Investment Gurus. Thank you.